Looking back to last week, Bridget, we saw the Reserve Bank come out with an unexpected interest rate cut. We've seen headlines, newspaper headlines, predicting up to $9 billion profit from the Commonwealth Bank. I think they're on track to $4.5 billion half year, so it's probably not far off the mark. Given that that's the case and that your average retiree, self-funded retirees, scraping through on, if they're lucky, 2.5% interest on their savings, but young people in particular who are big credit card users, they've been educated that way, are paying 17+% interest on their credit cards. Why cannot we, or why do we not need to have a Royal Commission into the banks? And if we don't, then what should we do to try and get some sanity back into the landscape?
Yeah, I think what we've got to understand is we have actually globally, we have a fantastic banking system. There were some issues identified through the Murray Financial Services Systems Inquiry that we're looking to implement those recommendations over time. So there are some issues. But if you look globally, our banking system is actually quite good. It protected us a lot during the global financial crisis.
It's underwritten by taxpayers for a start.
Absolutely, and there's a responsibility that comes with that underwriting. And so we saw that from this year. The Prime Minister and the Treasurer have made it a part of the House Economics Committee that the banks will actually have to front up and explain, rather than have the Treasurer have to explain. And we saw Wayne Swan have to go through this. We've seen other Treasurers of all ilks somehow having to justify to the Australian people the behaviour of corporate entities who are underwritten by the taxpayer. So hauling them in front of the Parliament to answer questions from the people's representatives, I think, is a responsible measure. It will actually be a very public account that those CEOs will have to do. And then there are, then the market people will actually be able to say, you know what, I don't like what you're doing, I don't like what you're saying. Whether you're a shareholder in that bank, you can take your ethical stance on whether you remain a shareholder of that bank, or if you're an actual customer of that bank, you can then shift your custom to somewhere else. The great thing about Australia is it's not just the big four. We always talk about the big four, but we have a vibrant customer-owned banking sector. So we have credit unions and building societies right here, right now, that have passed that on. So people need to be shopping around and being a bit more savvy about where they put their mortgage dollar, because we do have choices. I think when we look at the Reserve Bank's decision to cut the official interest rate by 0.25%, it wasn't actually to stimulate the economy per se, particularly when the rate's as low as it is. It was about actually protecting the Australian dollar. Right now, when you look around the world at the official interest rates, we're actually quite high. So you're looking, if you're an investor from overseas and you're looking, where can I park my money in this turbulent time, Australia's looking like a pretty good option. Our dollar goes through the roof, and who gets hurt? It is our manufacturing base, it is our farming, our producers that are all our exporters, and that underpins a lot of our economy. So it was less about providing mortgage relief. Because
I'd argue it doesn't anyway. $50 a month, I mean, what, a cup of coffee a week or 2 cups of coffee a week?
Well, to some people, $50 a month, is a lot of money. It might not be to you and I, but to some people it is. It's the difference between the kids doing a swimming lesson a week or not, at $10 a pop, right? So whether that wasn't the actual purpose of the interest rate cut. I think the positive measure that's came out from some of the banks was that they increased their term deposit rate. So for the self-funded retirees, or those that are actually having to use their deposits to live off, that increase to over 3% is a welcome relief.
It's got to be a worry though, Bridget, when you look ahead, and everyone's been singing from the rooftops for years, you need $1 million to retire on. And I mean, I said to Keith Sutherland the other day, I did some rough maths, and maths was not my strong point at school. I admit that up front. But even at $1 million, I worked out you'd pull about $27,000 a year in interest on current term deposit rates, so $500 a week, and the offset's the pension, of course, with your assets. So it's almost lose-lose at the moment for the average punter out there. And I just wonder whether, when the groundswell of opinion would seem to be from the majority of average punters, that they see the big four banks as pulling in huge profits, 17% interest, they're happy to take that on your credit card, but they're only throwing you 2.5% on your deposits. A Royal Commission would seem to be an obvious way to placate the average punter that says, hey, we want to find out what the hell's going on. But you believe the current setup with Turnbull will suffice?
Well, I think they're two very different questions. The outcomes of the Murray Financial Services inquiry will address a lot of the issues that have been highlighted by those calling for a Royal Commission into banks. I think what is lacking in this whole conversation, as you say, is transparency. And if you come before a parliamentary committee, you actually have to tell the truth, and they are the people's representatives that are asking those questions. So
so it might
you
be,
know, it's a little more rigorous, if you like, than a normal shareholder meeting. But you've got to remember that profit that is being garnered by those banks is going back to predominantly mum and dad investors who invested a long time ago in the Big Four. So it's not all bad news for having a strong and vibrant banking sector. But I do take your point. I think we've got a huge issue going forward with retirement.
Yep.
And actually ensuring that people can
only
retire
get worse
with, you know,
too.
absolutely, it's only going to get worse. I think there was a recent article by the Grattan Institute into unlocking the capital within people's family home, for instance, and just having a look at how we approach ageing and inheritance and retirement is something that we need to get serious.
There's a conversation I'd love to spend an hour with you on
No,
that
I know.
one.
And I've just been really interested in watching my own parents and their retirement journey, and it probably feeds into regional development a bit too, and about those sort of enclaves, if you like, of fantastic retirement destinations which are becoming you know, points of regional development as well, and the source of jobs and service provisions for towns right along the Murray, for instance, that have great golf courses.